$38 trillion. That is the United States' current debt, a figure that defies human comprehension, exceeding 130% of its gross domestic product. 14 trillion, the European Union. Almost 10 trillion, Japan, where the debt already surpasses 250% of its national GDP. And they are not the only ones. Every nation, every economy, every oil titan or export factory is submerged in a staggering debt figure. From the most mature markets to emerging economies, the obligation is ubiquitous, universal. And here lies the fundamental contradiction that the traditional press ignores and that superficial macroeconomics fails to explain. If absolutely everyone owes, if the account is global, if the liability is the norm, who is the creditor that holds the world? Is there really a positive balance somewhere? Or is the entire system a gigantic mirror illusion? Debt is not a burden. Debt is the invisible architecture of modern power. It is the operating software that dictates value transfers on a planetary scale. And if you follow the chain of obligations to its foundations, you will uncover the most uncomfortable truth of the system. The world owes itself. And here is the key that separates knowledge from mere information. That does not mean that the benefit or the risk is distributed equitably. In fact, the system is designed precisely so that they are not. To understand who is owed today, we must understand what is owed and how this sophisticated architecture of financial control originated. Sovereign debt is not, by any means, a modern phenomenon. Its foundations, however, were cemented in urgency, in the necessity of war. The genesis of the government bond is found in conflict, specifically in the year 1694. England, completely mired in a costly war against France, had depleted its physical gold reserves. The solution proposed by the Crown was an act of financial genius. It did not consist of acquiring physical gold, but rather a promise of value backed by the future, in exchange for a permanent flow of interest guaranteed by future taxes that had not yet been collected. King William III created a totally new instrument, a tradable promise. This was the birth of the bond, the birth of debt, and the direct reason for the creation of the Bank of England. It was a revolutionary move. The state acquired the ability to spend money it literally did not possess, and in return, lenders received a liquid asset guaranteed by the state's immutable taxing power. In this way, debt became the foundation of state credibility. If a nation could indebt itself with solvency and be viewed as secure, it was automatically perceived as a powerful nation. The battlefield moved to the balance sheet, and the ability to issue debt with confidence became the ability to govern. The crucial point here is that by dissociating expenditure from physical gold, the sovereign bond was established as the first modern monetary anchor. It became the safest asset in the system, a benchmark that private banks would later use to measure the risk of any other investment. The fundamental principle of modern money is not the intrinsic value of a precious metal, but the unshakable trust in a promise of debt issued by a government. That is the true currency. Let's fast forward. Today, that debt, particularly the U.S. one, is the absolute collateral of the global economy. The U.S. Treasury issues bonds to finance its deficits. The obvious question is, who buys them? A superficial analysis would tell us it's China or Japan. And that is true, they are large creditors. But if we systematically analyze the complete map, we see that 2/3 of the debt is, in reality, internal or intra-governmental debt. This means it is purchased by a vast network of American investors and institutions, pension funds, insurance companies, and, above all, the Federal Reserve. Yes, the central bank itself acts as a massive buyer, injecting liquidity into the system through the acquisition of its own bonds. Pension funds, for example, need zero-risk assets to back the promises made to their retirees, and that asset is, indisputably, the U.S. Treasury. Tax money funds the interest that flows back to the retirement accounts of the Americans themselves. It is a circular mirror, a closed circuit, where the debtor, the government, is also the main internal creditor through its citizens and institutions. Debt transforms into a mechanism for internal wealth distribution. The remaining one-third is what grabs the headlines, the foreign creditors. Japan with more than $1 trillion, China with hundreds of billions, followed by key financial centers like the UK and Luxembourg. But these countries do not buy debt out of charity, nor for a pure investment strategy. They buy it out of a necessity imposed by the system, and that necessity is the key to decoding the true flow of capital. If this analysis has redefined your understanding of the global economy so far, it is because we are revealing the hidden rules of the system. They are not theories. They are the mechanism of power now. Let's continue with the central engine of the system, the forced capital flow. The circularity we just described is only the surface. The debt architecture forces a capital flow that operates on a much larger, and often entirely invisible scale to the casual observer. This is the inflection point of our analysis. When an emerging economy generates large amounts of dollars through its exports or through foreign investment, it faces an obligation. It must park that capital somewhere safe, a place that offers liquidity and absolute confidence. These countries seek the safest asset on the planet to constitute their monetary reserves. The answer, you've guessed it, is the U.S. Treasury bond. This is not a simple investment decision. It is a liquidity tribute imposed by the system. The world, in seeking security in the dollar debt binary, is forced to systematically send its wealth to the financial core, Wall Street and the Federal Reserve. This phenomenon is severely exacerbated by the eurodollar system, a massive market of dollars operating outside the direct jurisdiction of the Federal Reserve. This shadow banking system uses the Treasury bond as its preferred collateral. This creates a demand for US debt that is, quite literally, insatiable, allowing Washington to finance itself at ridiculously low rates, even as its total debt level skyrockets. It is a cycle that is vicious for peripheral countries and virtuous for the hegemonic centers simultaneously. The entire world borrows dollars to trade, and to secure that loan, the world is obliged to buy us debt. This not only guarantees the dollar's hegemony as the primary reserve currency, but ensures that global liquidity remains concentrated in the centers of financial power. Behind every bond issuance are the arbiters who dictate the game, the hedge funds, the central banks of the major economies, and the powerful rating agencies. It is they, collectively, who decide which government borrows at a derisory cost and which nation pays a punitive premium to survive in the markets. And the central engine of this entire mechanism is, of course, the central banks. When the Fed or the European Central Bank (ECB) buy bonds, they are not simply managing the country's debt. They are actively manufacturing new money. What is debt on the government's balance sheet immediately becomes a liquidity asset on the central bank's balance sheet. Every unit of currency in circulation is, in essence, a unit of transformed debt. This systemic confidence is the only fuel that moves the global financial system. But when that confidence breaks, the architecture is revealed in the most brutal way. We are not just talking about external, isolated crises, like that of Greece in 2010, are talking about the internal systemic risk known as the doom loop or fatal loop. This phenomenon occurs when a country's banks buy large amounts of their own government's bonds. We saw it clearly during the European sovereign debt crisis. If the government's debt falls in value because the market fears a default, the banks holding it as assets drastically lose capital. To rescue those banks, the government must indebt itself even more, issuing more bonds. This, in turn, increases the perceived risk for the government, making the bonds worth even less, and the vicious cycle feeds itself. The risk is not reduced. It is magnified at the core of the system. When confidence breaks completely, the creditors become painfully visible. The International Monetary Fund, IMF, the rating agencies that dictate the sentence, and the anonymous bondholders who demand sacrifices from an entire generation of taxpayers. The system's goal is not to resolve the debt in a traditional sense, but to restructure the flow of capital. Names are changed, old loans are replaced by new ones, more expensive and under stricter conditions. The cycle restarts, yes, but always with control, more centralized than before. Debt is used as a mechanism to guarantee submission and alignment with financial hegemony. The uncomfortable truth, one that the press will never dedicate a headline to, is the following. Today's governments have no real plan to pay the debt. This is not a low-grade conspiracy theory. It is the global policy of stability. The debt is deliberately designed to be rolled over, that is, refinanced eternally, forever. A Treasury bond is not a promise of final payment. It is fundamentally a maximum security asset and the foundation of the entire modern financial market. If Washington, hypothetically, paid the last dollar of its debt, the world would lose the safest asset available, contracting the global dollar supply and causing a collapse. The system needs the debt alive to function as collateral. That is why, when we say we owe it to ourselves, it is only half the truth. The flow of interest systematically moves upward, from the tax-paying citizen to those who own the collateral. Global inequality and global debt are not statistical coincidences. They are the logical and necessary result of the same systemic engine. The creditor is not a country. It is not Wall Street. The creditor is the system of debt converted into money that rewards the ownership and control of the safest collateral. Our mission is to decode and reveal this truth, making the invisible visible. If this analysis has broadened your view of macroeconomics and capital flow, it is because you have begun to see the invisible architecture behind every dollar bill. The difference between thriving or simply surviving lies in understanding this. Power dynamic. Inertia is the greatest risk. Reflection on the future. What do you believe will be the next major asset the world seeks to use as collateral when confidence in the sovereign bond begins to wane? This concludes our deep analysis